my name is Thalia Petousis and I'm one of the co-managers for the Allan Gray Income Fund. And today I thought I'd share with you some of my thoughts for 2025, just in terms of the broader macro environment, inflation and interest rates, and then how we're positioning the income fund as a result. So to kick us off, I thought what better way to start than to touch on the fact that we've emerged from this 2024 really super election year. And what a year it was. I mean, it was a year in which we saw really around the globe legacy serving political parties being defeated en masse in elections. And a great way to think about the year that passed was, from an electoral standpoint, it was really the bonfire of the incumbents. And I have a few headlines that I'm putting up on the screen that speak to that. And I think that what we saw was really global dissatisfaction regarding inflation and regarding very harsh economic conditions coincided with this phenomenon of a spike in the election cycle. And we know that high inflation has been a great dethroner of reigning political administrations throughout history. And that's really as disillusioned constituents express their frustration with economic hardships. Now, how do they express this frustration? Well, they rally against the status quo, they rally against its incumbents, and they rally against perceived political elites. And this was as true for South Africa there at the top as it was for the US, for the UK, for India, and also for parts of Europe like Germany and France, where we saw these very fragile minority governments dissolve under no confidence votes. And we also saw a lot of anti-establishment and anti-government rhetoric around the world last year. And, you know, I like to reflect on Javier Milei. He's the president of Argentina. He served his full first year last year in 2024, and he's become quite popular with the quote, really, that the public sector is an illness. And I think it's that sort of rhetoric that really resonated with voters last year. And then moving on to the markets. I think, you know, in the 2024 super election year, market returns really mirrored political outcomes. And I've got three charts just to demonstrate that. And the first, I think of it as the perception of capitalism outwinning over the perception of socialism. So what we've got in this chart is we've got the US dollar returns. Okay, if you had invested in a Brazil 10-year government bond in Jan 2024 versus an SA 10-year government bond in Jan 2024. And then throughout the year, what would your returns have looked like? And you can see the staggering divergence. You know, you ended the year in SA earning almost 20% in dollars, and in Brazil, you would have lost 30% of your money in dollars. So, I mean, what informed this divergence? Well, certainly, you know, recent changes to the SA government via the GNU, they're seen as overwhelmingly positive. They're seen as pivoting the country away from populism and towards pro-growth policies, market-friendly reform, some form of capitalism, and structural reforms. Whereas Brazil, on the other hand, leftist President Lula has, you know, been very negative in terms of market returns. He ramped up government spending. He caved to a whole host of populist measures like tax breaks. And really, Brazil's government deficit as a percentage of GDP, it's approaching, you know, minus 10% of GDP in a single year. So that's quite staggering. It really threatens the sustainability of government debt. And I like to think, you know, that red line, so the experience of Brazilian investors being invested in 10-year government bonds, that could have been what SA returns would have looked like if the ANC had chosen to form a coalition government with MK and EFF. But we instead, you know, we went the other way, and I think many people are very glad for it. Then my second chart, just to demonstrate how market returns mirrored political outcomes, it's just a very simple chart. It's euro-dollar. And we can see euro-dollar towards the tail end of last year, it was really trading around parity. And the euro lost, you know, in 2024, about 7.5% of its value against the dollar from its peak. And then actually versus its 2021 peak, the euro's lost 16% of its value against the dollar. And really, some of the recent impetus for the move has been, weighing up Trump's win versus the very fragile EU minority governments that have been in place, as I said in the beginning, many of which have started to topple and experience no confidence votes. Whereas a lot of the hubris around the dollar and the US stock market has been informed by President Trump's election, the perception that he's going to come with a lot of pro-growth US policies, in particular for the manufacturing sector. While over in Europe, things are looking quite different. And then my third chart, it also actually speaks to European fragility. What this chart shows is the red line is the spread between Greek versus Greek versus German 10-year government bonds. Okay, and then the grey line is the spread between Italian versus German 10-year government bonds. So you can see that narrowing in spreads that we saw throughout 2024, that really reflects the market's poorer assessment of Germany's creditworthiness and the market's poorer assessment of Germany's stability. So Germany is really emerging as this new EU poster child for political dysfunction. They've had to head to the polls yet again after the dissolution of Chancellor Olaf Scholz's minority government, and there are a lot of concerns that came through both in the political arena and via market returns. Now, moving ahead, I think something very important to discuss at this juncture is what has changed in terms of inflationary thinking as we sit at the beginning of 2025. And obviously this is quite important for income funds, for how we position our fund, and for the trajectory of interest rates. Now, in mid-December, Fed Chair Powell in the US, in my mind, finally admitted, that the Fed got inflation wrong yet again. In his speech at the end of the year, at the end of the Fed meeting, he said their year-end inflation projection has kind of fallen apart. And we can see that here in this next chart. So what we're looking at is US consumer price inflation broken down into its component parts. So you can see that big shock in 2021, 2022. That was really led by higher food prices, higher fuel prices, and higher core goods prices. And since then, those have abated. But what we've started to see is this classic second round reflation effect, where you get the initial shock by food and fuel, and then what follows is that workers demand higher wages, and that then bleeds into higher prices for services, any services, medical services, veterinarian services, high admission for sporting events, etc., travel services. So we've seen that pink area, services inflation, reset at slightly higher levels than pre-pandemic. And that is informing that black line, which is US core inflation, that's informing why it ended the year at about 3.3%, whereas the Fed was feeling quite confident for much of last year, 2024, that core inflation was going to come in probably somewhere around 2% or even sub 2%. And I think what's really important to keep in mind, and it's something that we've been saying for a while, is that once inflation is baked into the cake, it's really the devil's own job to get it back under control. That's what the history of inflation has really taught us. And also, I think what's really interesting is, we saw the Fed pivot in terms of its rhetoric last year, but arguably, US Treasury yields have been telling us that something was wrong on the inflation side for some time. So they were really the canary in the coal mine. And what we're looking at here in this chart is you can see the black line is the federal funds overnight rate. From the time that the Fed first cut rates there in September, 20-year US Treasury yields just started to sell off. And that's very uncommon. If you look at the history of past Fed rate cutting cycles, usually US Treasuries then are quite well behaved. Sometimes they rally, yields come down. But instead what we saw is through the first 100 basis points of interest rate cuts, we saw US 20-year yields sell off by 100 basis points. So they were really warning the market. The Fed might not be winning this battle against inflation. Some of the labor data that's coming through is very strong. There might be cause for concern. Now, I think it's important to question now, where to from here? And we've been saying for quite some time, some of you may be familiar with this slide, that there are really these 5 Ds driving global inflation. It's demographics, decarbonization, deglobalization, debt, and defense. And I want to hone in on deglobalization in particular, because I think it's quite important when thinking about the 2025 year. Now, this next chart, it's a very long-term chart. from 1900s to kind of 2024 are US tariffs over time. So the tariff that the US has leveraged against the end of the world over time. And we can see how they've come skyrocketing down. And in fact, Trump's 2016 tariff hikes are just this tiny blip there at the end of the chart. You can barely see them. Okay? Whereas the pink area is what Trump proposed in 2024 as the potential tariff band for the world ex-China. So he's been saying he wants to raise tariffs back to 10% to 20%, from their current on average 2.7% for the world ex-China. And he said for most of 2024 for China, he wanted, a far greater tariff. And obviously this has a lot of inflationary consequences. So, when we think about positioning our funds, this is something that we're taking into account that's also feeding our 5Ds narrative. And I think, around Trump, he's made sure that there's quite a bit of support around him for this idea of raising tariffs. So even his US Treasury Secretary pick, Scott Bessent, he also shares very similar ideas with Trump around tariffs. And in fact, their ideas, a lot of them are actually copy-paste from former US President Ronald Reagan. So a lot of these ideas are not necessarily true. And I think what's so interesting is if you look back at the Reagan administration and a lot of what Reagan was saying in the 1980s, it's very similar to what Trump was saying now, actually across a few policies, not just tariffs, also the Panama Canal. Reagan shared similar views. But Reagan's view on trade, and this is quite interesting, he said, not all free trade is actually free. Free trade is by definition fair trade. And now he said this next bit, and he was speaking at the time in reference to Japan, but when Trump says it now, he's speaking in reference to China. Reagan said, where domestic markets, for example in Japan, for example in China, are closed to the export of others, it is no longer free trade. So they're just doing a one-way deal. We'll export to you, but we're not going to take anything else in. When governments, again, foreign governments, Japan at the time and China now, subsidize their manufacturers and farmers so that they can dump goods in international markets, that's no longer free trade. When governments permit counterfeiting or copying of American products, it is stealing our future and it is no longer free trade. And then Reagan ended his speech in 1985 in the White House by saying, I will not stand by and watch American workers lose their jobs because other nations do not play by the rules. Now, unfortunately, some of that has played out in the time since. So US manufacturing jobs have been cut, and Trump would argue that as US worker wages have come down because of pressure from the Chinese labor market, it's also created this phenomenal wealth gap, which has been quite negative. And really, some of what's also stimulated that wealth gap is the fact that what does China do with all of its trade surpluses? Well, a lot of them have been reinvested into the US stock market, which has then made wealthy Americans who own the stock market even wealthier. Again, while you have wages in country in America, coming down. And I thought that's really interesting. Just the entire argument, especially if you think about it in relation to SA today. Some of you reflect, I'm sure you've seen the recent headlines this year just on our steel industry and what's been happening with ArcelorMittal, and really the heavy competition that we also face from the Chinese manufacturing sector. So really, Trump's solution is tariffs, which he calls the most beautiful word in the dictionary. That's a quote from Trump. And one more thing I'd like to say on tariffs and potential inflationary pressures is that I think another reason why there's this strong impetus coming from the Trump administration is because what we have a chart of here is US excise, so tariff receipts, as a percentage of fiscal revenue. So how much are tariffs contributing to fiscal government revenue? And we can see they've come down from about 15% back in the 1950s down to about 2% today. So really, raising tariffs would also raise revenue for the US government at a time when it's Trump's desire to reduce personal taxes to some degree and keep the US corporate tax rates unchanged. Now, tariffs and a tariff war obviously have some impact for global inflation. What's interesting is if we take this discussion back home to SA, we haven't seen reflation coming home. Okay, so what I've got here is a chart of SA minus US inflation. So what's the gap? And you can see we ended the year at pretty much flat. So we were both around 2.8%, 2.9% headline inflation. This isn't core inflation, it's just headline. Okay, which is quite unusual for us. You know, the history of SA versus US inflation suggests usually we run our inflation at about 3% higher than the US. And really, you know, the reason why reflation hasn't come home is because we don't have the dynamics for broad-based wage inflation like you saw in the US. We have a structurally weak labor market. We have sky-high unemployment. And obviously, you know, we don't have the sort of environment where you can see a rising services inflation. Now, you might be tempted to say from this chart, okay, ergo, the Reserve Bank has a lot of scope to cut rates in this sort of environment, far more than the US. But I think this next chart is quite interesting in response to that. One of the things that the SARB keeps maintaining, and they maintain this throughout 2024, is they're quite concerned about administered price inflation. So administered price inflation there is that red line, whereas the black line is SA, just headline inflation. You can see how much higher administered prices have been, how much more volatile they've been, and that's really SA consumers paying for the cost of broken municipalities. And in terms of the outlook going forward, we know that Eskom has asked for double-digit tariff increases going forward. That's obviously going to inform the trajectory of that red line. But then beyond that as well, this is just a chart of Eskom's energy spend last year in terms of capital infrastructure investment. So that grey area, that grey bar where it says 2024 spend, they spent 37 billion rand last year, and that was really just maintenance. That was maintenance on, you know, generation, etc. Going forward, Eskom has indicated they're going to need to spend about 3.5 times greater than that per annum, so 137 billion rand per annum, on expansion by generation, transmission and distribution, so that they can now start building out transmission lines for all of these renewable energy projects to plug into. And that's obviously going to have some sort of impact on electricity tariffs. You know, these costs need to be borne somewhere, and in general, those are borne by the consumers. I think the SARB is looking at all of this, and it has fed into a lot of their hawkish rhetoric that came through last year in 2024. Now here I've just got a nice simple chart of SA real cash returns in excess of inflation. So I've just used our own Allan Gray money market fund yield in excess of inflation. You can see we ended the year close to a 6% real yield, and that's because inflation had come down to about 2.9%, very low. Now we know this has to come down. I mean, this is excessive versus history, but what's interesting is if you look at this next chart, that grey dotted line, that is the SA repo rate over 2002 to 2024, and you can see we're much higher than pre-pandemic levels, is the market has been forecasting, and especially in fact since the Fed's big pivot in December on rhetoric, the market has been forecasting for hardly any rate cuts this year. And in fact, the market has been forecasting for the repo rate to stay quite elevated versus 2015 to 2019 levels. So, you know, when one thinks about this, when running an income fund, you know, it's tempting to then say, okay, well, if you felt it was attractive to be in an income fund in 2015 to 2019, the conditions now should be at least as attractive, if not more so. Again, because the SARB is worried about, you know, they're looking at the global situation, they're looking at tariffs, they're looking at our own administered price issues, and this is weighing on their ability to cut rates. I think it's also quite dangerous for us, even though our inflation gap versus the US has been so narrow, it's quite dangerous for us to break too far away from US monetary policy, just because we obviously need to attract foreign funding into our market. We cannot fund ourselves, you know, fully from a local standpoint because of our twin deficit issue. So the market is only really pricing for a very mild rate cutting cycle. And then the last thing I wanted to touch on, and this is quite important when positioning an income fund or actually any fixed interest fund, is the cash versus bonds relative. And I'll just reflect, you know, when looking at this relative, firstly, on what a year it's been for SA bonds. I mean, 2024 was staggering. So here's just the SA 20-year government bond yield over time from 2009 to kind of end 2024. And I mean, look at that sharp rally, that final blue arrow. And that's obviously as a result of sentiment, again, around the GNU formation. So not actually seeing real GDP growth coming through, but preempting it. And then also the injection of 100 billion rand of cash into government's cash reserves via JAFECRA, because that means government needed to raise 100 billion rand less debt than what they would have. And that's obviously then positive in the sense that, there's less paper floating around. And I mean, if government had put out an announcement last year, oh, we're going to have to increase the borrowing requirement by 100 billion rand, that would put a lot of pressure on yields. I don't think you would have seen this kind of picture play out. But Jafekra also really came to the rescue. Then, just one more chart on the ALLB. Well, actually, I think I've got two more. But this is the All Bond Index relative to cash. So you can see last year the All Bond Index beat cash by about 14%. Again, quite staggering. I mean, you'd have to look back to kind of the GFC move, the post-COVID move, and obviously those moves followed quite a big sell-off. So it's not quite the same. So it was really staggering. And then this one. This is the All Bond Index return relative to the EM Local Bond Index return in dollars. And you can see just through the course of last year, this is just 2023, in December 2023 to December 2024, it was 18% outperformance of the ALLB in dollars. So really staggering. And I think, now one needs to question, when looking at the cash bond relative for us when positioning the income fund and even our other fixed interest funds, is the market trading away from fundamentals? So what I've got here is a chart of the SA 10-year bond versus the US 10-year bond spread. And you can see towards the end of last year, it traded down to 578 bips, the spread, which is a very narrow spread. I mean, you'd have to look back to Ramaphoria to have last seen that spread. And then, before that, you'd have to look at, way back pre-Nenegate to see those sorts of spreads. Is it justified from a fundamental perspective? One thing that I struggle with is obviously, we've accumulated a lot of debt since that 2018, that prior low. And in fact, our pace of debt accumulation has been much faster than the US. So just unpacking that, this slide, compares SA's fiscal situation, in 2019 versus today. So that first little graphic shows SA 20-year government bond yields, kind of pre-COVID, they were 10.2%. September 2024, we got to 10.7%, so just a 50 bips gap, hardly any gap at all. But then if you compare our debt to GDP, that's taken a huge step change higher from 55% to 75%. If you look at our cost of financing, that's the next little graphic, we went from spending 15 cents on every tax rand towards government's interest bill to 25 cents on every tax rand towards government's interest bill. And then that final graphic is just government's cash reserves, their cash buffer, and that's halved. Since pre-COVID, it's gone from 300 billion down to 150 billion, and that's even with the Jafekra injection. So from a fundamental perspective, this does pose question marks around whether or not the degree of the rally, let's say, versus other markets is warranted. And then I also thought I'd take a look at us versus Mexico. I mean, this is quite an interesting chart. This is 2011 to end 2024, the SA 10-year bond versus the Mexico 10-year bond spread. And you can see, I mean, typically we traded 200 bips to 300 bips wider than Mexico. We traded down to, zero spread. In fact, the SA yield was slightly lower than Mexico's yield at the end of the year. Is this warranted from a fundamental perspective? Here I've just got Mexico's debt to GDP over that time period versus SA's debt to GDP. And you can see Mexico's been very well behaved. I mean, the debt to GDP has stayed around 50%, 52%, whereas SA, we've taken a huge step change higher. Now, I mean, the counter to this is you could say, okay, yeah, but Mexico's facing some issues at the moment. They have the threat of tariffs from the Trump administration. That could definitely impact growth to some degree. Whereas SA, we're going to see higher growth going forward under the GNU, and even just via the absence of load shedding. We have to rebound from a growth perspective just because of that being removed from the equation. One issue there, though, is Mexico's been running at 3% real GDP growth. So I'd say it's quite a tall order to expect the GNU to slash SA's government debt to GDP by 20% of GDP and deliver consistent 3% real GDP growth, which I think might be needed in order to warrant, a flat spread versus an EM like Mexico. And then I thought now I'd just move into some of the income fund positioning, how we've been adjusting the fund of late. So what I've got here is we launched the fund beginning of May, and you can see those dark grey bars. That's the Allan Gray Income Fund yield spread versus cash. So you can see it's been around 175 bips, 1.75% in excess of cash since we launched. It went down to 1.55%, ended the year at about 1.9%. But you can see that modified duration positioning. So we launched at 1.5 modified duration. In fact, intra-month we got up to 1.8. And then we cut that into this big rally on duration assets down to about 0.8, which is, roughly where we are at the moment. And I think, through this presentation and through my questioning of, what's underpinning this fundamental move for the degree of the rally, you can maybe, understand some of the rationale for cutting some of that duration positioning into this big rally we saw on fixed rate assets. Then this just shows the red bars of the Allan Gray Income Fund gross yield. That's gross of fees. And then the pink is the All Bond Index gross yield. And you can see when we launched, we were at 10% versus the All Bond Index at 11%. So a nice, 100 bip gap if you were in the All Bond Index, also with high duration in the All B. So to benefit, in terms of capital appreciation in a rally. But then by September, the Allan Gray Income Fund yield was actually slightly higher than the All B yield. It was 9.9% versus 9.7%, which we felt was actually quite curious. And obviously we had much lower modified duration. Our modified duration was 0.8 by then, whereas the All B typically runs at 5 to 6 sort of modified duration. And some of that is a result of obviously this big fixed rate rally, but then also the market was pricing for floating rate instruments, which are really the bread and butter of an income fund, for those yields to come skyrocketing down over the next little while because of these deep interest rate cuts that were priced in. And we weren't on that train. We didn't think the SARB was going to deliver, some 200 bips worth of cuts, take the repo down to 6%. So we were quite happy to sit in the floaters. Also, if you think back to my 5Ds graph, we're thinking quite carefully around what's driving global inflation and the impetus globally going forward and what the direction of travel is going to be. So we're quite happy to be in floating rate instruments. So you can see here, floating rate instruments, they're still the bulk of the fund at 53% of the fund. And then actually in Q4, we did raise money market exposure slightly. And a lot of that was around the time of this Fed pivot in rhetoric. The market started to reprice money market rates high. It started to remove the expectation of rate cuts. And ergo, you had something like 5-year fixed money market trading up to about 9.25% yields, which is quite nice, kind of as a kind of stocking filler for the fund, as kind of a nice base rate for the fund. Then I won't touch too much on credit exposure since it remains very conservative as it has been since launch. So I'll end off there. Thank you very much.
Well, Thalia, what an overview you've just given us as 2025 kicks into gear. And this fund certainly has a role to play in an investor's toolkit, right, given the market environment. But I'm going to prod a little bit more here. Considering the positioning of the Allan Gray Income Fund, what specific instrument exposures sets your fund apart from other income funds out there?
Thanks, Alicia. It's a great question. I tend to think, one of the things that really separates our fund from a lot of the others out there, and there are many income funds in the mix, is firstly, pricing integrity. We mark to market all of the instruments in the fund daily, even if they are structured products. So you'll have seen actually in one of my last slides, I reflected that we had 18% of fund in credit-linked notes. We have those valued daily at a fair unwind price. And we've tested those prices. We've tested them in large size. So if the bank is going to show us an unwind price, they better be willing to stick to it. So we've unwound in large size, not just across the income fund, but many other funds at that fair unwind price, just to test the system, so that we know the fund is accurately priced. So I think that is one thing that sets us apart. Then also we're quite a conservative fund, so we're very conservative on credit risk. We understand the pitfalls of taking on undue risk just to earn an extra 20 to 30 basis points. It's not a game that we are in. We value liquidity, so we think our fund is quite a bit more liquid than a lot of the other funds out there. In other words, we could very easily liquidate this fund if we had outflows. So I'd say those are some of the main things. And then, I mentioned we have a conservative credit risk appetite, and beyond that we also have a very strong equity and credit team. So most of our investment analysts wear two hats. They function as equity analysts and credit analysts, and they really understand the cash flows and the sustainability of any debt issuer, whether it be government, a state-owned entity, a bank, a corporate credit, and we leverage off of our equity expertise to really make sure that we're doing very robust credit assessments of anyone who we might lend to within the fund.
So Thalia, looking at a few of the forces in play impacting things here, how do you see a higher risk-free rate globally and the emergence of fixed income real returns in the US affecting the local fixed income space?
Yeah, it's actually something I've been reflecting on recently, just because, we're not in this 0% US interest rate world anymore, as we were back in 2018. And I think we can already see how that's played out or had an impact on the SA bond markets, in that in 2018, around that period when offshore rates were zero and parts of Europe the overnight rates were negative, there was this dramatic hunt for yield from offshore investors. I mean, listen, at the time we also had an investment grade credit rating, which helped us as well. And foreigners owned 40% of our total debt markets. And I mean, since then, that's come down to 25%. And I think that's twofold. So partly losing our investment grade credit rating, we're not in many indices, but also having higher interest rates offshore. So being able to say, okay, well, instead of banking zero on a US Treasury bill, I can bank 4% to 5%. That changes the mindset of asset allocators offshore. And occasionally, foreign pension funds come and chat to us here and speak about what they're doing in their funds, and a lot of them have reflected on the fact that asset allocators are no longer as keen, and asset consultants, to allocate as much to the EM bucket when they know they can sort of quite safely take home 5%, 4% even on short-dated US Treasury instruments. So that means there's less cash then available to flow into the periphery of financial markets, being emerging markets and South Africa and so on. So I think the impact we're already seeing, and that's partly why I don't think we'll get to those staggering levels of foreign ownership we saw in the past.
Yeah, and of course, that one thing to consider, but locally, we've also started to see a shift in terms of interest rate movement, right here in South Africa as well. So how have the SARB's recent interest rate decisions started to influence your fund's strategy, if at all?
So, I think the SARB has been incredibly consistent. In some ways, they've never needed to pivot, and they've preempted. In 2021, they were very early to start hiking rates, long before the US. And last year, they were, as I mentioned in my presentation, US Treasury yields were the canary in the coal mine, warning the market things are not going, that well. And, maybe the Fed is cutting a bit too preemptively. The SARB was also the canary in the coal mine. They were also warning the markets and saying, inflation could be much more persistent than what you realize. I think at one of the year-end MPCs in 2024, they almost called out foreign central banks and said, we think you're going too far here. Are you not alive to the risks? So we think they've been very consistent. They've stuck to their guns. They've never indicated that they're going to put through, as I said, 200 bips or something dramatic worth of rate cuts. And that has influenced our positioning in that, we felt more comfortable to be in floating rate instruments because we don't think you're going to take this huge knock in terms of yield over time. And that's then, you can see that coming up in our income fund positioning. And our reasonably low duration.
Thalia, thanks for that update, really illustrating Allan Gray Income Fund's strategy and positioning in the market right now.